Assalamualaikum and good day everyone. We are Group 8 from BWBB3037. We will be presenting our topic, which is Operation in Treasury Trading Room. I'm going to introduce my teammate, Muhammad Hafizuddin bin Hakim, Intan Haslina, Daniel Josephine, Muhammad Faiz, and Shamita. Today I will be presenting introduction part. Treasury management or treasury operation can be described as a process of planning, managing and controlling an organization holding assets and working capital in order to maximize the use of fund, maintaining liquidity, lower overall funding costs, and limit operational and financial risks. A bank treasury department has a responsibility of balancing and controlling the bank daily cash and liquidity of the money. Furthermore, the department is also in charge of bank security, foreign exchange, and cash investment. The basic responsibility of any bank treasury department is to guarantee that its asset and match the liability in every possible way. Moreover, a trading desk is a physical location where transaction from buying and selling security occurs. During on the type of financial institution, the trading desk may be filled by traders trading for their own property account, brokers who act as an agent matching buyer and seller, or something mixture of the both of them.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Faiz bin Kamal. My metric number is 2779. So for today, I will present about the basic trading room operation mechanism. So before that, I will explain the meaning of the basic trading room operation mechanism. I will explain more about the basic trading room operation mechanism. So, the trading mechanism refers to the logistic behind trading asset and securities, regardless of the type of market. This market can be exchange dealer or OTC market. The mechanism are the operation by which buyers of an asset are matched with the seller. The next one, we go to the types of trading mechanism. Basically, there are two main types of trading mechanism. The first one is quote-driven market, and the second one is order-driven market. First one, I will present about the quote-driven market. So for the quote-driven market, continuous price of quotes are provided to buyer and seller. These prices are provided by market makers, which means this type of system are better suited for dealer or OTC market. For a buyer, the price provided is the price a dealer is willing to sell at. For a seller, the price provided is the price a dealer is willing to buy at. Typically, the quote's buy price will be lower than the sell price. The spread is the profit that the market maker, the dealer, makes. So the next one, I will talk about the order-driven market. So for order-driven market, buyer and seller of asset are able to place order for asset they wish to purchase or sell. They can list of market price which execute a market order instantly at the best available price. Alternatively, they can list a fixed or limit price which execute either a limit or stop order, not to be executed until certain pricing conditions are met. In an order-driven market, counterparties are not necessarily available immediately, depending on the list price. Because this is so, order-driven trading mechanism are more suited for exchange. Order will execute once a suitable counterparty is found for each buyer or seller. In other words, a buy order will only execute if a seller is found who is willing to sell at the specific limit price.
Hello, my name is Shamita, daughter of Balan, and my matrix number is 273077. For my part, I will be talking about the computation of effective yield and cost of funds. Effective yield is a financial metric that measures the interest rate, also known as the coupon rate return on a bond. Effective yield is calculated by dividing the coupon payments by the current market value of the bond. The effective yield metric is that it takes compounding into consideration. It is important because bonds typically pay interest more than once a year. It makes effective yield a more accurate investment return metric than the nominal or simple yield metric, which does not take the effect of compounding into account. However, one drawback of the effective yield metric is that it assumes that the investor or the bondholder can reinvest the interest payment that they receive at the same rate as the stated coupon rate on their bond. For example, if an investor purchases a bond that pays a 7% coupon rate, the effective yield calculation assumes that the investor can reinvest all the 7% interest payments they receive in another bond or similar investment that will also provide an ongoing 7% return. Since interest rates are constantly fluctuating, the above is an unlikely scenario. In an economic environment where interest rates are declining, reinvesting at the same interest rate as the received on a previously purchased bond is virtually impossible. As for the cost of fund, is the interest rate that a financial institution pays on the funds they use in their operations. In other words, the cost of funds is how much banks and other financial institutions must pay in order to acquire funds. Cost of funds is calculated by multiplying the proportion of each source of funds by its cost and adding the results. When funds are utilized for short-term and long-term loans to borrowers, the cost of funds is one of the most important input expenses for a financial institution because a lower cost will result in better returns. When a bank's funds are used to make loans to borrowers, the cost of money is reduced, which equals better returns. One of the key sources of profit for many banks is the differential between the cost of funding and the interest rate given to borrowers. The interest rate provided to depositors on financial products such as saving accounts and time deposits determine the cost of funding for lenders such as banks and credit unions. Although the phrase is most commonly associated with financial institution, the cost of funds has substantially impact on most businesses when they borrow money. Many banks make money in two ways, through cost of funds and net interest spread. Interest rates are charged by commercial banks on loans and other items that consumers, businesses, and large-scale institutions require. Banks must charge a higher interest rate on such loans than the interest rate they pay to borrow the fund in the first place, which is the cost of funds.
A very good day. My name is Daniel Josephine, metric number 272593. I will proceed on the presentation of catering to importers or exporters' needs in the forward market. A forward market is a marketplace that provides financial instruments that are priced in advance for future delivery. The main instruments in the forward market is called as forward contracts or forwards. It is commonly known as the foreign exchange market, but that is also applied for commodities, securities, and interest rates. Forward contracts or forwards are used between customer and a bank or between two banks. These contracts are massively flexible, making the number one contributor in attracting importers and exporters in the foreign market. Their main purpose is not much different from the future contracts, which is being used for hedging and speculation. Nevertheless, forwards have their big advantage of being able to customize according to customers' preferences. Now, let's look on how forward market helps importers and exporters. Importing and exporting goods will have different types of problem every time a transaction happens. One of them is having unexpected change in the exchange rate. When this happens, importers and exporters will use the forwards to do hedging, which helps them to reduce the risk of having an unexpected change in the exchange rate. Hedging decreases the possibility of suffering losses by an associated investment and increases liquidity as it motivates investors to invest in different asset classes. It also considers the proportion of trade with each and every country.
Good day, Sir Shahril. My name is Muhammad Hafizuddin Hakim. I will explain about the central bank intervention mechanism. A central bank might intervene in the market to buy or sell its domestic currency when the government has a policy of fixed rate. It might allow its currency to float or allow only limited fluctuation in the rate for its currency. When the government has a policy of fixed exchange rate, intervention would be made to prevent a devaluation of the currency by buying the currency and selling off some foreign exchange reserve. It might also prevent revaluation of the currency by selling the currency in exchange for the foreign currency. When the government allows its currency to float, the central bank might still intervene to buy or sell a currency. If the government considers that exchange rate for the currency has appreciated or depreciated to an unjustifiable level, sometimes a government allows only limited fluctuation in exchange rate of the currency. So there will be an intervention point at which the central bank will be intervened once the currency has appreciated or depreciated to a threshold level. The first reason central bank intervene is to stabilize fluctuation in the exchange rate. International trade and investment decisions are much more difficult to make if the exchange rate value is changing rapidly. Whether a trade deal or international investment is good or bad often depend on the value of the exchange rate that will prevail at some point in the future. So if the exchange rate change rapidly up or down, trader and investor will become more uncertain about the profitability of trade and investment and will likely to reduce the international activities. As a consequence, international traders and investors tend to prefer more stable exchange rate and will often pressure government and central bank to intervene in the foreign exchange forex market whenever the exchange rate change too rapidly. The second reason central bank intervene is to reverse the growth in the country trade deficit. Trade deficit or current account deficit can rise rapidly if a country exchange rate appreciates significantly. A higher currency value will make foreign goods and services (GNS) relatively cheaper, stimulating import, while domestic goods will seem relatively more expensive to foreigners, thus reducing export. This means a rising currency value can lead to a rising trade deficit. If the trade deficit is viewed as a problem of foreign economy, the central bank may be pressured to intervene to reduce the value of the currency in the foreign market and thereby reverse the rising trade deficit. So graph 1 shows goal of foreign intervention by central bank reported by Bank for International Settlement (BIS), which is more than half of the central bank report intervening to maintain price stability. This is not surprising as the exchange rate has a major influence on inflation. Its impact especially strong when expectations become unanchored. We can see contribution by Argentina. Furthermore, exchange rate misalignment caused by financial shock might also shift the domestic Phillips curve, such as by driving a wedge between production and consumption or changing the price of intermediate goods. Naturally, the reliance on exchange intervention will depend on the monetary policy regime, the size of foreign exchange reserve, and why the theory adjusting the interest rate is the best tool to achieve price stability. Exchange rate intervention may be used in support or even as an alternative when the room for maneuver on the monetary front is limited. So next, we move to the mechanism by central bank. There are two methods central bank can use to affect the exchange rate. The indirect method is to change the domestic money supply. The direct method is to interfere directly in the foreign exchange market by buying or selling currency. So there are two mechanisms by central bank, which is the indirect and direct. So the first one is the central bank can use an indirect method to raise or lower the exchange rate through domestic money supply change. Despite relatively quick adjustment in asset market, this type of intervention must traverse from open market operation to change in domestic money supply, domestic interest rate and exchange rate due to new rates of return. Thus, this method may take several weeks or more for the effect on exchange rate to be realized. So the most obvious and direct way for central bank to intervene and affect the exchange rate is to enter the private forex market directly by buying or selling domestic currency. there are two possible transactions. The first one, the central bank can sell domestic currency. Let's say that we use dollar in exchange for a foreign currency, say pounds. This transaction will raise the supply of dollar on the forex, also raising the demand for pounds, causing a reduction in the value of the dollar and thus a dollar depreciation. Of course, when the dollar depreciates in value, the pound appreciates in value with respect to the dollar. Since the central bank is the ultimate source of all dollar, it can effectively print an unlimited amount. It can flood the forex market with as many dollars as it desires. Thus, the central bank's power to reduce the dollar value by direct intervention if the forex is virtually unlimited. In conclusion, nowadays technology plays a critical role in the day-to-day operation of the Treasury trading room by enabling information communication and processing capabilities. Technical Services Division must be equipped to build methods that assure the smooth operation of existing technology. It is critical to emphasize that Treasury is responsible for overseeing all aspects of aforementioned responsibility and ensuring that all risk positions established by other part of the bank are brought under the Treasury umbrella. Occasionally, brokers are employed to act as middlemen between banks. They are compensated by the two banks engaged in the transaction. Actual dealing rates are collected from broker through one or more institutions. Treasury functions in general play a critical role in the bank operations. A good Treasury trading room team will have a beneficial impact on the institution. This is because the Treasury is one of the important departments that to ensure the bank or company involved in foreign exchange are successful and able to make profit. So that's all from us. Thank you.